It's Tuesday, August the 11th. Welcome to Business Morning. I'm Chimeze Obi Iwagu. We kick off on the global oil market front as prices gained more ground this morning, with prices underpinned by expectations of U.S. stimulus and a rebound in Asian demand as economies reopen. Brent crude added 22 cents to $45.21 a barrel. West Texas Intermediate U.S. crude rose 32 cents to $42.26 a barrel. Prices found support after U.S. President Donald Trump tweeted that top congressional Democrats wanted to meet with him on coronavirus-related economic relief. The talks between Democrats and the Trump administration broke down last week. A weaker U.S. dollar also helped support higher oil prices. After steadying on Monday, the dollar was again slipping on Tuesday, easing 0.1% against a basket of currencies and falling further against riskier currencies like the Australian dollar. China's factory deflation eased in July, driven by a rise in global oil prices and as industrial activity climbed back towards pre-coronavirus levels, adding to signs of recovery in the world's second largest economy. Energy companies have begun taking back millions of barrels of oil from the U.S. government's emergency stockpile after renting storage in the facility to help manage a glut of crude this spring after energy demand collapsed during COVID-19 lockdown. And back here, what happened like a strategic decision earlier in the year when the federal government opted for deregulation of the downstream petroleum sector and insisted on price modulation for premium motor spirit or petrol seems to have been left in limbo as the price remains uncertain. The Petroleum Products Marketing Company last week fixed the ex-depot price of petrol at 138 naira 62 kobo per litre. The ex-depot price is the price at which depot owners sell the commodity to retail outlets. Currently, marketers seem divided across states as to the most appropriate price for the product, with most selling between 148 naira and 160 naira per litre, depending on the state. But let's have this conversation with an energy lawyer and chairman OTL Africa Downstream, Emeka Akabogu. Good morning, Mr. Akabogu. Thank you for joining us on the program. Mr. Akabogu, so what do you make of this recent ex-depot price template released recently by the PPMC? Well, we seem to be having audio issue there, but I guess we'll get that rectified very soon and come back to Mr. Akabogu. In the meantime, the Minister of State for Petroleum Resources, Mr. Timipre Silva, has reiterated the federal government's resolve to improve investment and domestic use of the nation's gas resources. Speaking at the launch of the Nigerian Gas Transportation Network Code online platform in Abuja, Mr. Silva explains that initiative is expected to serve as a component for gas business and transactions in the domestic gas market.
Nigeria is endowed with abundant natural gas resources, which in energy terms is in excess of the nation's proven crude oil reserve. The current reserve estimate of the Nigerian gas is over 120 trillion cubic feet, with about 50-50 distribution ratio between associated gas, AG, and non-associated, with only a small fraction of this quantity currently being utilized. In order to diversify its revenue base and reduce the huge loss of valuable resource, as well as the degradation of the environment as a result of flaring, the federal government has launched the Nigerian Gas Transportation Network Code online platform, which is aimed at competitive access to gas transportation infrastructure and development.
The implementation of the network code, which is a set of rules and principles guiding the use and operations of the gas transportation network system, will deepen the domestic gas market and unleash the potential of accelerated growth and economic development for our dear nation.
With the launch of the online portal, industry experts are hopeful that the nation's gas sector will be better for it. The latest move, according to them, is expected to drive more investment and gas utilization in the country.
This is the beginning of progress for our industry, particularly for the gas industry, because without this, without having the infrastructure to transport gas from source to end users, we would have been wasting our time and definitely not getting the value.
We want to use this to guarantee investment. We want also use this to enable participation, because when we issue license, investors will come. When we issue permits, we enable participation.
An agreement is thereafter signed by players in the gas sector who will be facilitating the initiative to drive the process. Hopefully, the initiative will shore up the nation's revenue base, deepen investment, as well as provide opportunity for local gas consumption.
All right, let's look at the commodities space now. Well, I guess it's one of those days that the network can actually be very funny. Anyway, I'm being told that Mr. Emeka Akabogi is back with us. And Mr. Emeka Akabogi is an energy lawyer and chairman OTL Africa Downstream. Good morning, Mr. Akabogi. Thank you for joining us on the program.
Thank you very much for having me.
So, what do you make of this recent ex-depot price template released recently by the PPMC?
Well, it is expected because there has to be a basis on which petroleum products marketers are taking products and on which they are pricing what they are putting out. You know, the last time we had a discussion on this, the PPPRA had released a market-based pricing regime for the industry and had at that time indicated that the price caps for petroleum products had been removed. Essentially, the interpretation was that the market had been deregulated. Of course, while some people had concerns about the nature of that deregulation, given that there were some range of powers which were still within the remit of government, the fact is that since that time, they have issued monthly guiding prices for retail. So what has happened as of now is that the monthly guiding price, the last monthly guiding price, I think was released sometime in either late June or early July. But that for August has not been released. So what we have is an ex-depot price released by PPMC, on the basis of which the market operators and the retailers have essentially adjusted to what they believe should be an appropriate pricing.
Hello, Mr. Akabogi, if you can hear me. I said marketers have argued that the ex-depot price of 138 Naira 62 kobo is not friendly. What do you think may be the concerns of these marketers?
Of course, yes, I can hear you now. I think the primary concern will be that relating to foreign exchange benchmarks. You have a situation where virtually all marketers cannot access foreign exchange at the CBN rates. So, and the foreign exchange today stands at about 470, in fact, between 475 to 480 Naira. You have to have in mind that even if the pricing is ex-depot, there are quite a lot of other cost variables which intervene in the pricing which the marketers will be faced with. And these cost variables will include shipping. It's ex-depot, but you know, you still have to get products up to in vessels right into the tanks. You still have to pay port charges, which are quite considerable and which are denominated in dollars. There are a range of market indices which require that the payments are dominated in dollars. And these dollars count significantly at the end of the day. So what needs to happen really should be that the PPPRA will have to give a pricing for the current regime which we have for the retail. For some reason, PPRA has not done that recently. And I would not be surprised if the reason it hasn't done that is because it probably is challenged by the reality of publishing pricing which may not be very politically wise. But that is what it has to do, because that is the reality of deregulation, where you need to proceed with what the market says at this time. So the chances are that if the appropriate pricing is in place, then we probably will have slightly higher than the 148 which you have right now.
Now, this whole thing seemed to be creating a lot of confusion. Is it fair for the consumers? For instance, people in Lagos are paying 148 naira for fuel, while someone perhaps in the east is paying 160 naira to get his fuel. Is this really fair for consumers?
Well, it's not fair to anybody, whether they are consumers or they are marketers, indeed, or even the government. It's not fair to anybody, but that is the reality. You see, we must pay for what we consume, and we need to start learning that as a country. Someone must pay. So if the government has said there is no more subsidy, the government has been subsidizing petroleum products forever, and probably the government has been hit. In fact, the reality is that the government has been hit very hard by the volume or the value of the subsidy which has been pumping into the petroleum market to maintain the price at 145 previously. And it's no longer able to do that in the reality of what it's facing. So someone has to pay. So if you're going to consume it, you've got to pay for it. That's the reality. Now, whether it's fair or not, I think that's where we now need to have governance mechanisms which are able to palliate these impacts. It's important, of course, that the funds which are designated to important areas like road construction and mass transportation, those should be properly appropriated and properly utilized. These are the things that can mitigate the impacts of these prices. But whether the prices are fair or not, those are the prices which are the reality on the ground. In fact, you will notice that the petroleum retail companies have fixed the prices that they are using, essentially fixed it across board as an association or as a corporate group. And that's because PPPRA has not been forthcoming in recent weeks with current guiding price for retail. And that is one of the challenges which is faced, and it's one of the areas in which you need to have the government agencies coming alive at this time, because you need full transparency, you need full access to information by the public and by the operators. And in the absence of that, there's no vacuum in life doesn't permit a vacuum. So you have situations where what is deemed to be appropriate pricing will be used at the retail end.
So what does that tell you, about the government's price modulation strategy? Is it really working?
Well, I'll say that it is working to the extent that even in the absence of a guiding price for August by PPPRA, the market has adjusted. And I think there is legal basis for the market having adjusted. I think in 2016 or 17, thereabouts, PPPRA came out with what they called an appropriate pricing framework, which should guide the markets. Even though that appropriate pricing framework probably was not really reflected in the operations, but it was there and I don't think it was withdrawn. Under that appropriate pricing framework, there are some responsibilities which accrue to marketers. And these responsibilities include ensuring that there is full recovery for pricing, and also there's sustainability of margins. So these are things which are existent in an extant guideline which has been issued by PPPRA. And if in the absence of a monthly guidance for pricing, there has been an adjustment ex depot, it is only appropriate that what is considered to be fair in the circumstances could be given, and that will be in line with the law, which I think is what has been done. So at the end of the day, I think what needs to happen is what we've suggested previously, which is that the subsidies which had been in place previously be stopped. However, you need to have governance mechanisms which identify on a sustainable and precise basis those elements which are most important to mitigate the impact of the prices. So mass transit is one of those crucial elements. And once you take care of mass transit, the majority of Nigerians will be taken care of, because it's been found empirically that the subsidies which are in place are subsidies which are for the elites and for the rich. The masses are just interested in mass transportation, which, if taken care of, would resolve most of those challenges. It also calls in play the need for discipline in energy consumption. So, I mean, there are areas where people practice carpooling, for instance. This also impacts on energy consumption and the discipline where we show when we consume energy. So across board, I think it's time for everybody to pull up his or her sleeves and face the reality which requires adjustments in our lifestyles.
And many, have argued that full deregulation of the downstream sector is the way to go to attract investment, although the government had argued that they wouldn't want marketers to exploit Nigerians. What's your take, particularly with this recent development?
The position of governments is absolutely spot on. Marketers should not be given the opportunity to exploit Nigerians. Well, the question is, are marketers exploiting Nigerians at the current pricing which we have at the pumps? My answer would be no, because the current pricing which we have at the pumps is just 10 naira above the ex-depot price. And have in mind that the margin which you have will take into account the operational costs which it takes to have fuel at the pumps. These include port charges. These include throughput charges. These include haulage. These include operations at the various terminals, at the pumps themselves, right? The huge costs of the jobs and people who are currently employed within this segment, which goes in the millions. And of course, finally, it includes elements relating to transportation outside the landing area. So if you're going to other parts of the country. And of course, that calls into question the continued role of organizations like the Petroleum Equalization Fund. Because the Petroleum Equalization Fund is there for the purpose of bridging the costs between the port locations and the inland areas. And if you have a situation where there is a price reflective, or rather cost reflective pricing, then it may be appropriate to say that the role of that organization may be reviewed within the large context of ensuring that the market is operating optimally.
Okay, thank you very much, Mr. Akabogo, for sharing your thoughts there with us. Anyway, I still have here Temitope Olubile still dwelling on this particular issue we're talking about, commodities here. Well, I'm sure you listened to Mr. Akabogo talking about the developments in the downstream sector. We've seen the oil price coming up, so are we likely to pay more for fuel?
I mean, the direction that we see that policymakers are taking now is, our domestic pump price to be reflective of global, oil price. And, in a time where revenue is strained, you want to be able to save as much as you can. So if you remove the subsidies that they would have paid to, keep prices at a fixed rate, you could use those subsidies saved for other, development and infrastructure needs. So, I mean, it makes sense at this time for PMS price to be reflective of global oil price. Yeah.
All right. Just hold your thoughts there. Of course, we'll get back to you. We'll take a quick break, and of course, we'll continue with this conversation. To stay with us. Well, still talking domestic commodities market, and I still have here in the studio Temitope Olubile, one of the research analysts with Financial Derivatives Company. Thank you very much, Temitope, for sticking on. All right, let's look at some of those burning economic issues there. External reserves, of course, have continued to dwindle. The CBN's forex rationing continues.
Yes.
What does that tell us?
Okay, so, like you said, external reserves just seems to be on a downward spiral. We're still going down. We're about $35.6 billion now. And, with...
despite the fact that we've seen oil price creeping up.
Yes, that's despite the fact that we've seen oil price, because CBN has, all these obligations that at a time like this, they have several obligations they're trying to meet. And, that explains why at a time like this, there's forex rationing, because we're not earning enough dollars from our export goods and even from other dollar earning sources like diaspora remittances, investment flows. We're not seeing that, coming in to, boost our external reserves. So that's why the CBN is rationing the forex now. Corporates, they're not able to meet. They're only meeting a small amount, a small percentage of corporate demand. And, even banks are having to ration the forex available to them. And, we may start to see the effect of that fully manifest when, global supply chains are fully back to, normal, what they were before the pandemic. That what would happen to import demand of these corporates that depend on, imported inputs, and, they will have to, book ahead of time. They may have to spend more for inventory, keeping of the inventory, because you have to book way ahead of the demand, the estimated demand. So that all these things are going to eat into their profits, the profits of these corporates.
And this is irrespective of the 41 items that were removed from accessing foreign exchange from the central bank.
Yes, and we saw that recently there was that banning of maize.
Yes.
All of these are all forex rationing strategies. Now, the what we're seeing is now the meeting only a small percentage of corporate demand. High ticket forex demands are not being met by banks, and even the corporates are not able to access forex easily. So that's what we're seeing play out now.
Now, if this persists, what will that mean for domestic commodities prices eventually?
I mean, there will be the pass-through, the imported inflation. There will be that. We'll see the effect really on that side on that sub-index of inflation, because exchange rate pass-through. First, you're not able to access the dollar, and then when you now access the dollar, there's that higher price you're paying more naira to meet to get just $1. So we see that would play out more in imported inflation. We can already see flour. If you take, for example, flour has already increased to 13,000 for a 50 kg bag. That's the exchange rate pass through already playing out. And when we see things like flour, what happens to your bread that flour is used to make, so we see that will play out in domestic commodities soon.
Now, the central bank over the weekend officially, adjusted the exchange rate, on its website. Yes. Why do you think the CBN had to wait till now to really do that?
I mean, I can't really speak for them, but I mean, I think why they had to do it at this point was, investors were, becoming skeptical. We saw even the World Bank had to postpone the meeting on giving us the loan support. So we see that those events had to I think that those events had to put pressure on the CBN, and they just had to. I mean, we're not fully at the IEFX rate yet, but we see that there has been that second adjustment for the year. So they had to, at a time like this, to be able to, international multilateral agencies are looking, and you want them to be able to give you these loan support facilities. You need it for your external reserves. You need it to meet your obligations. So they had to at a time like this. Yes.
Now, are we likely to see more adjustments, on the rates in the near future?
I mean, I think we might. Let me put it like that. I think we might, because we're not fully at the IEFX rate, and the goal is to get to the IEFX rate and unify all the windows center it around the IEFX rate. And 379 is still a way off from 388 that we're seeing the IEFX trade at, the IEFX rate trade at. So it's possible. There's still that possibility on the table, yes.
Now, one of the goodies there is that interest rates could reverse downward trend. How so?
I mean, because first you see that, you're spending more naira to get, the dollar. So we see that there will be that mop up of liquidity from the system because of the exchange rate adjustments. And when that happens, we'll see that interest rates, less liquidity equals to, higher interest rates. So that is how that will play out. And we think that is a possibility in the near term for interest rates to reverse the downward trend.
Okay, again, on the burning economic issue, we have there Nigeria targets 100,000 tons of cocoa output in Ondo and Cross River states. Tell us about this. Nigeria, cocoa happens to be Nigeria's
key export.
Yes,
yes, it's one of our key agri exports. And, this time when your exports are cheaper, you need to... Again, your exports are cheaper and you're still not earning enough dollars from your export goods. So you need to look at diversifying your revenue base. And I think there's been more focus on, these cash crops, because cocoa is a huge cash crop right now. And, if we see that if they're able to meet the target of 100,000 tons in Ondo and Cross River State respectively, that would, that would put in about 200,000 tons of our total output, so of total cocoa output. So that is good money that we need right now. And at a time when your exports are cheaper, these, and you'll be able to get more forex from these export goods. So it's a good time to diversify your revenue base. And before, cocoa used to be just strictly for the southwest, your Ondo, your Ogun, your Oyo, but now we see it going into the southeast. Cross River State is looking to boost its cocoa output, and that's really good for our export revenue.
Now, soybean prices, to remain depressed on weak Chinese demand. What's the implications for Nigeria?
Yes, I mean, Nigeria, we do about less than 500,000 tons for soybeans, and we see that there's the problem with our soybeans output right now is the crushing capacity, because the primary user of soybeans in Nigeria is for animal feed, is the animal feed industry. And when we see that there's no crushing capacity, the animal feed industry is not able to get the output that they need. But at a time when soybean prices the global soybean prices are projected to remain low, it's not really, and we also have the quality, domestic quality concerns. So it's not really a good time for our soybean output right now. But I mean, again, we still need to diversify our export base as much as we can.
All right, let's look at other commodity price movement. Can you take us through those movements there and their drivers?
Okay, so for domestic commodities, we see that yam, we're seeing more new yam in the markets. Before, old yam was trading at about 3,000, for a medium size. But now we're seeing new yam into the markets as we approach the New Yam Festival. So that has, really brought yam prices down. We can see you can get a new yam medium size for about 1,150 now, and that's coming from what we were getting before at 3,000. We're seeing that play out, and as we get into the harvest season of more of these domestic commodities, we'll see that the increased supply would push down prices. But even if prices are pushed down, consumer disposable income is still very weak, and they may not be able to demand for as much as they used to. But we're hoping that harvest season will push down domestic commodity prices in the near term.
So what's the general outlook for commodities market? So,
the general outlook is that except for your imported goods, which there's a lot of imported goods in the market, in domestic market, you should expect a significant increase in domestic goods. The exchange rate pass-through will begin to really play out, and that would really bore a hole in consumer pockets. But your domestic commodities, as we approach the harvest season, we're projecting that these commodity prices would fall.
What about oil commodity?
Oil remains, a volatile commodity where we're seeing that there's that demand optimism. Saudi Arabia is saying, Asian demand is picking up, and that's, that was good news yesterday. We're also seeing the supply optimism. Iraq, which was mentioned alongside Nigeria for, not complying with their OPEC quota, they've promised and they've committed to deepen output cuts. So there's those supply and demand optimism playing out, but the demand concerns still remain, because if you look at the countries that are leading the COVID cases now that are having a second wave, you have US, which is a key exporter of the commodity, and we have India too. These countries that import and use this commodity a lot, there's still that demand concern of what happens if there's a second lockdown.
All right, Tony Tobe, thank you for your time. We'll be back in a moment. Well, President Muhammadu Buhari has signed an agreement for the instrument that will allow the establishment of Trade Insurance Agency for African countries. The agreement and the agency, which are registered with the United Nations Secretariat, seeks to provide support for insurance and other financial instruments and services for trade, investment, and other activities across the continent. A statement from the presidency explains that the agency will acknowledge previous efforts made by African countries towards regional economic integration through free trade in order to achieve sustainable growth and create an enabling environment for foreign trade and cross-border investment. And for a quick review of Monday's equities trading and outlook, here is Temple Ashaju. Temple, the week started with profit-taking at the equities market.
Correct. We saw some profits taken, but at the same time, we saw a whole lot of buy sentiment, because if you look at the market breadth yesterday, Chimeze, recall, we've got 18 gainers against 11 losers. And of course, that tells you that there's a bit of interest in the market, in spite of the fact that we're down yesterday by some 0.06%. Nonetheless, we didn't drop below the 13 trillion naira market equity capitalization that we've settled as, luckily for us, in recent times. Look at the activity level. Yesterday, it improved by some 5% in terms of volume of transaction. We got some gains here. And of course, Unilever, which has actually been at a year-to-date low of more than 42%, got some interest yesterday. We saw some huge volume on that company yesterday. It traded around some 12 naira yesterday. The volume of transaction we saw there yesterday was like 17 million, valued at 206 million naira. Now, if you look at what that translated to here, we were able to get some 175.32 million naira. And of course, that's after the company gained some 7.14% in terms of trading yesterday. But then again, that reduced its year-to-date performance, which has been negative, to some 42.03%. Look at the value of transaction yesterday, lower than what we did at the preceding trading session. We had some 1.4 billion naira worth of transactions yesterday, even though we got some gains on GT Bank and a couple of other major stocks that you have some key bellwethers there. Value in terms of deals of transaction, we had 4,294 yesterday, higher than what we did in the preceding trading session, which will be Friday there. Now, look at the sectoral performance of the market. Banking stocks were down marginally yesterday. These was actually moderated by the gains that we saw on Axis Bank and, of course, GT Bank, which were able to help weather the storm yesterday, because what brought this segment into the red territory was as a result of the sell down we saw on ETI, on Jais Bank, and a couple of other sectors. Here, for the consumer goods side of the market, we got some gains, Unilever, as I explained earlier, and of course, we got gainers. Then, industrial goods side of the market, we got some key profits taken again on UBA, on Boa Cement, I beg your pardon. That Boa Cement was down by 1.39%. Insurance side of the market, Cornerstone was up 9%. And of course, oil and gas was positive yesterday because we got O&O rising by some 58 basis points. We have Mr. David Adonri joining us now via phone right now. He is a stock trader with High Cap Securities. Mr. Adonri, thanks for joining us on the program. But we've seen the resumption of the FGN savings bond now in the market. Is that going to be like a distraction to investment in equities? Okay, we'll try to rejoin Mr. David Adonri. But then let's look at the oil and gas space here. Things are really gray yesterday, remained flat, or Adova hasn't actually moved since Friday. Corn oil, of course, declared its numbers recently, but there's basically nothing too interesting to chew on that side of the market. Then O&O was positive by 58 basis points yesterday. Nothing on the MRS, nothing on 11 PLC. We're yet to see the listing of that company. Looks like things are beginning to change in terms of decision for the board members of that particular company. But let's look at the NASD side of the market again, which is still equity based. Here we were unchanged yesterday, and of course we still have the index settling at 706.07. Look at the market capitalization still hovering at 518.65 billion naira. Now, if you look at the volume of transaction that we have, it was 16.09% higher than what we did at the preceding trading session. Was 146,490 yesterday. And of course, we know that First Mortgage is a major bank that has actually been contributing recently in recent times to what we're seeing in this space. On Friday, it did contribute to the volume of transaction. And of course, yesterday, Monday, it contributed some 86,000 units of its shares were traded yesterday. We also know that 46,000 units of CSCS shares were also traded on this platform yesterday, coupled with some interest that we also saw in Niger Delta Exploration Production Company, which is a major active stock in on that side of the market. Wamco, your milk maker, don't forget, did also perform yesterday, and all of that put together accounted for the 146,490 units of shares that we have. They're all valued at 4.89 million naira in all in 16 deals. Mr. Donry, we have you back on phone now. Quickly talk to us in perhaps less than 1 minute. I mean, we're seeing the FGN savings bonds now come back into the market, albeit with the fact that rates are not looking so attractive. But is that going to be a major instrument to help investors rebalance their portfolio in the market?
Yes, it's a good development, considering the fact that the low rates on debt instruments is rebalancing the situation in the capital market, and this is allowing financial assets to migrate more into equities now, and that is the driving factor that has resulted in last week's rally in the equities market. And so we're having the imbalance, the yield imbalance between debt and equities now being completely addressed. And so the capital market is now better balanced. So we have activities quite a lot in the equities market now, and also a lot of activities in the debt market.
Right. Okay, so let's talk a bit more about the equity space. We haven't seen the tier one names releasing their earnings. What exactly do you think is delaying their numbers? Because typically they're the ones that will be the first to release.
Well, the tier 2 banks have already released, and the results quite unexpectedly were impressive, and that was the other reason why the equities market experienced last week's rally. Is an indication of what we are to expect from the tier 1 banks. Then we'll say that the appreciation in the equities market is likely to be sustained in the future. But the performance in the real sector has not been very, very impressive, but it has been counterbalanced by what we have from the banks. Okay, so which may be indicative of the fact that the banking sector has been able to weather the storm.
Okay.
Considering the fact that the second quarter has been
Mr. Adonri,
where we thought the market will be.
Mr. Adonri, thank you so much. Thank you so much for those insights. Let's hope that things improve in the real sector so that the consumer goods side of the market, which has actually been dipping lately, will be able to get some more activities. Mr. David Adonri is a stock trader with High Cap Securities on the Nigerian Stock Exchange. Chimeze is back to you now.
Let's hope that happens, Temple. All right, we'll take a break, and when we come back, we do a crossover to London, and then back to you, Temple.